Imagine navigating a ship without a compass. Risk monitoring is that compass for banks, ensuring alignment with their risk appetite. It guides management and the board in maintaining consistent risk exposure. Effective risk monitoring facilitates informed decision-making. It provides senior management with the tools to evaluate strategies and ensure they align with the bank's risk appetite. Interest rate risk reporting is crucial for evaluating exposure. Regular, clear, and concise reports help assess compliance with risk tolerance levels, ensuring the bank's strategies are on track. These reports allow the board to evaluate trends and make informed decisions. They highlight policy exceptions and assess the sensitivity of key assumptions. The board sets the risk appetite, influencing interest rate risk tolerance. Risk limits should be reasonable and aligned with the bank's profile, ensuring they are neither too lax nor too rigid. Management must justify any breaches or high limits. Prompt attention to breaches ensures that the bank's risk exposure remains within acceptable boundaries. Examiners assess the appropriateness of risk limits. These limits should control exposure while aligning with the bank's financial condition and risk appetite. Frequent breaches require strong justification. Management must articulate why exposures exceed limits and how they plan to address these issues. Earnings at risk (EAR) limits control risk to earnings in specific scenarios. Management computes EAR relative to net interest income, ensuring strategies reflect the bank's size and complexity. These strategies should be dynamic, adapting to changes in the bank's environment. They help maintain a balance between risk and reward. Equity at risk limits address complex instrument holdings. They ensure that the bank's equity ratios remain stable under various scenarios. Gap limits control maturity or repricing imbalances. Both limits are crucial for managing overall interest rate risk, especially in complex banking environments. Management evaluates risks from business growth and strategies. Strategic plans and simulations help anticipate future exposures, ensuring the bank remains resilient. Dynamic simulations capture a range of interest rate risk exposures. They provide a comprehensive view of potential risks, aiding in strategic decision-making. Trade-offs exist between short-term earnings and economic value. Managing economic value can affect short-term earnings, requiring careful balance. Banks set limits around possible outcomes to manage sensitivity. This ensures that both earnings and economic value are protected against adverse scenarios. Recap: we've explored the importance of risk monitoring, effective reporting, and strategic management. By understanding these elements, banks can navigate the complexities of interest rate risk. Takeaway: by implementing robust risk management strategies, you'll ensure your bank's stability and resilience in the face of changing interest rates. Call to action: start by reviewing your bank's current risk management practices. Identify areas for improvement and implement changes to enhance your bank's risk resilience. Together, let's build a future where your bank thrives amidst uncertainty. Take the first step today and secure your bank's financial health.